Today we're doing a complete breakdown of Learn ASC 606 Revenue Recognition, full U.S. Generally Accepted Accounting Principles course, included journals. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Prior to ASC 606, companies could recognize revenue in wildly different ways, creating confusion and inconsistency. Imagine two similar companies reporting vastly different revenue from similar transactions. ASC 606 standardized revenue recognition, ensuring comparability and transparency. By understanding this, you'll grasp how businesses accurately report billions in revenue, enhancing investor trust. ASC 606 was a game changer, unifying disparate revenue recognition practices. Before its introduction, industries had their own rules, leading to inconsistencies. Imagine two software companies selling identical products under different revenue rules. ASC 606 aligned U.S. Generally Accepted Accounting Principles with international financial reporting standards, streamlining practices, ensuring global comparability, and providing a robust framework for recognizing revenue accurately across industries. All public companies in the U.S. must follow ASC 606 as of 2018. It also applies to private companies, though they had more flexibility with adoption timelines. The key criterion? Revenue is recognized when control of goods or services transfers to the customer, not just when cash is received. This standard impacts industries across the board, ensuring uniform reporting. The 5-step revenue model is central to ASC 606, demanding precision in revenue recognition. Start by identifying the contract, then pinpoint each obligation. Calculate the transaction price and allocate it accordingly. Finally, recognize revenue as obligations are fulfilled. This model isn't just theory, it's a cornerstone of financial reporting. Mastering it can set you apart in interviews, showing you understand revenue with precision. Scope matters because it defines where ASC 606 applies. Overlooking exclusions like financial instruments can derail an interview. Many assume all revenue is covered, but that's a trap. Understanding what falls within and outside the standard's boundaries is crucial for applying ASC 606 effectively in real-world scenarios. When applying ASC 606, focus on contracts involving customer interactions like sales or services. An IT company selling software licenses must evaluate whether control transfers at a point in time or over time. Recognizing these nuances ensures accurate revenue reporting, aligning with the standard's aim for consistency and comparability across industries. ASC 606 specifically excludes leases, insurance contracts, and financial instruments, each governed by distinct standards like ASC 842 and ASC 825. Misapplying ASC 606 to these can lead to significant reporting errors. For instance, treating a lease agreement as a revenue contract under ASC 606 would misrepresent both revenue and obligations, impacting financial transparency and decision-making. Contracts in ASC 606 establish enforceable rights and obligations, crucial for revenue recognition. Imagine a retailer signing a contract to purchase 1,000 units of a product. This agreement outlines delivery expectations, payment terms, and penalties for non-compliance. Understanding the contract's details ensures accurate revenue recognition, aligning with ASC 606's stringent guidelines on performance obligations and transaction pricing. Performance obligations under ASC 606 are promises to deliver specific goods or services. Consider a software firm selling a product with a promise of future updates. Each update represents a distinct obligation, separately identifiable from the initial sale. Recognizing these obligations ensures revenue aligns with delivery, preventing premature recognition and aligning with ASC 606's core principles. Edge cases challenge understanding of ASC 606's scope. Consider free installation offered with a product. If installation is distinct, it's a separate performance obligation. Gift cards fall under ASC 606 as they represent an obligation for future goods or services. Non-refundable fees tied to service obligations must also be recognized per standard guidelines, ensuring accurate revenue depiction. Imagine a tech startup selling $10 million in software annually. Struggling with revenue timing. The 5-step revenue model eliminates confusion, standardizing when and how revenue gets recognized, ensuring investors and stakeholders see a true picture of financial health. The 5-step revenue model is about clarity and consistency. For instance, a construction company with multiple contracts can use this model to appropriately recognize revenue at each project milestone, avoiding inflated or deflated revenue figures. It's about painting a clear financial portrait that aligns with economic realities. Identifying a contract is crucial. It's the foundation of revenue recognition. Suppose Meridian Corporation signs a $2 million contract for bespoke software. They must ensure enforceable rights exist and terms are clear. Many err by assuming any agreement qualifies, forgetting the ASC's emphasis on commercial substance and clarity. Identifying performance obligations requires precision. Tech Innovators, for instance, in a $500K deal, offers both cloud services and training. Each is a separate obligation. A common slip is bundling distinct services, ignoring ASC's mandate for separability, leading to inaccurate revenue allocation. Determining the transaction price demands accuracy, especially with variable elements. Consider retail giant's $1 million deal anticipating a $100,000 discount. Factoring such variables is essential. Many fail by ignoring them, misrepresenting revenue. ASC guides using expected value, or most likely outcome, to ensure precision. Allocating transaction price involves precision. Global Tech's $3 million package splits into $1 million for installation, $2 million for software. Mistakes often occur with arbitrary splits, ignoring ASC's focus on standalone prices. Proper allocation ensures each obligation reflects its true economic contribution to the contract. Recognizing revenue aligns with satisfying obligations. Imagine Construction Co. progressively recognizing $5 million as building milestones complete. Many stumble by mistiming this, either early or delayed. ASC demands revenue mirrors performance, focusing on when control transfers, ensuring revenue truly reflects business activity. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 606 requires detailed disclosures, ensuring stakeholders understand revenue sources and reliability. Making informed decisions here is crucial for accurate financial reporting and maintaining investor trust. Recognizing revenue at the right moment can make or break financial accuracy. ASC 606 dictates revenue recognition when control passes, not just on delivery. This means if a $100,000 transaction is agreed upon, that amount is recognized only once control shifts to the customer, ensuring precise financial reflection. Subsequent measurement involves revisiting contracts when modifications occur. ASC 606 requires any change in transaction price to be reallocated. For example, if a contract price increases by $10,000 due to additional services, this adjustment is reflected in the current period, aligning financials with reality. How revenue is displayed in financial statements significantly affects perception. Under ASC 606, revenue is presented on the income statement distinctly as revenue from contracts with customers. This clarity helps stakeholders differentiate between product and service revenues, with contract assets and liabilities clearly positioned on the balance sheet, enhancing transparency. ASC 606 mandates crucial disclosures to ensure transparency. Disaggregating revenue by category reveals patterns, helping analysts understand performance. Judgments in revenue recognition must be disclosed for investor confidence. Contract balances show progress in fulfilling obligations, while significant payment terms impact cash flow analysis, providing a fuller financial picture. Imagine a CFO managing a $2 million contract with a clause for future price increases. Monitoring modifications ensures timely revenue recognition and compliance with ASC 606. This avoids costly restatements and maintains investor trust by reflecting real-time financial health accurately. Demonstrating the practical impact of these standards? Meridian Corporation, a global manufacturing company, signs a 5-year, $1.2 million contract to deliver customized machinery to a major European client. Follow the step-by-step journey of revenue recognition as Meridian navigates ASC 606, transforming complex transactions into clear financial statements. To recognize the $1.2 million contract under ASC 606, Meridian records an asset in accounts receivable and a liability in deferred revenue. This reflects Meridian's right to payment and obligation to deliver. Recognition aligns with ASC 606's core principle. Revenue is recognized as control of goods or services is transferred to a client. Delivering machinery worth $240,000 in the first year allows Meridian to recognize this portion of revenue. By debiting deferred revenue and crediting revenue, Meridian adheres to ASC 606's performance obligation criteria, ensuring recognized revenue reflects completion of contract terms. This enhances the accuracy of revenue reporting. Recognizing $150,000 in cost of goods sold against inventory reflects the direct expense associated with delivering $240,000 of machinery. ASC 606 mandates matching costs with recognized revenue, ensuring that financial statements reveal the true cost of fulfilling contractual obligations, enhancing profitability insights. As Meridian delivers $240,000 in machinery for the second year, it recognizes revenue equal to the delivery value by moving it from deferred revenue to revenue. ASC 606's performance obligation framework drives this entry, ensuring that revenue reflects completed delivery stages, maintaining consistency and reliability in financial reporting. Recording $160,000 in cost of goods sold ensures that expenses related to the second year's delivery are accurately matched with recognized revenue. This entry supports ASC 606's requirements, where expenses are incurred in alignment with the revenue recognition process, offering a true picture of profitability. Adjusting for $50,000 in unrecognized revenue helps Meridian align its financials with ASC 606's transfer of control principle. By moving funds from deferred revenue to revenue, Meridian ensures that all delivered goods are reflected in the financial statements, preventing understated revenue and enhancing transparency. Upon completing the $1.2 million contract, Meridian recognizes the final $720,000 in revenue by transferring it from deferred revenue to revenue. This entry signifies the fulfillment of all performance obligations, as ASC 606 dictates, ensuring that financial statements reflect the total economic benefit derived from the contract. The $450,000 in cost of goods sold represents the expense associated with the final machinery delivery. By derecognizing inventory, Meridian adheres to ASC 606's matching principle, ensuring that costs incurred align with the recognized revenue, providing a transparent view of the company's profitability and cost management. Every Big Four and investment bank interview on Learn ASC 606 revenue recognition. Full U.S. Generally Accepted Accounting Principles course included journals, follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 606 is the standard for revenue recognition, ensuring consistency across industries. It exists to provide a robust framework for recognizing revenue from contracts with customers, replacing the previous industry-specific guidelines. A common mistake is confusing it with other standards like ASC 605. Remember, it emphasizes the timing and amount of revenue recognition. A performance obligation is a promise in a contract to transfer a product or service to a customer. It's crucial because it determines when and how much revenue is recognized. For example, in a software contract, each software license might be a distinct performance obligation. Misidentifying these can lead to incorrect revenue timing. Revenue is recognized when control of goods passes to the customer, usually upon delivery. For instance, a retailer records revenue upon delivery, not order receipt. The challenge is ensuring performance obligations are met. Remember, revenue recognition hinges on transferring control, not just delivering a product. The transaction price is allocated based on standalone selling prices of each performance obligation. For example, a bundled sale of a phone and service plan requires individual pricing. Misallocating can lead to incorrect financials. The key takeaway is to ensure allocation reflects true value distribution. Both standards aim for similar objectives but differ subtly. ASC 606 offers more guidance on variable consideration, while Indian Accounting Standard 115 aligns closely with International Financial Reporting Standards 15, adopting a principle-based approach. Recognizing these nuances can prevent compliance issues. Remember, the core framework remains consistent across standards. Revenue is recognized over time if the customer receives benefits as the performance occurs, like in construction projects. For example, a building company records revenue as work progresses. Misunderstanding the criteria can lead to revenue misstatements. Focus on the transfer of control and benefit realization. Estimate variable consideration using either the expected value or most likely amount method. For instance, a bonus based on sales targets involves estimating likely outcomes. Incorrect estimates can distort financials. Remember, choose the method that best predicts expected revenue, considering constraints like potential reversals. ASC 606 excludes transactions like leases, insurance contracts, and financial instruments. For instance, a lease agreement falls under ASC 842. A common mistake is applying ASC 606 to these transactions. The takeaway is knowing when ASC 606 doesn't apply, ensuring correct standard application. Performance obligations focus on the promise to transfer goods or services, while delivery dates are about the physical transfer. For instance, revenue might be recognized before the delivery date if obligations are met. The trap is equating the two, leading to incorrect revenue timing. Key: obligations dictate revenue recognition, not delivery. CFOs must disclose qualitative and quantitative data, like disaggregated revenue and performance obligations details. For example, breaking down revenue by product line. A common failure is insufficient detail, risking non-compliance. Mastery tip: ensure disclosures are thorough, providing clear insights into revenue streams and obligations. ASC 606 reshapes how businesses recognize revenue by providing a unified framework. It applies broadly, with exceptions for leases and financial instruments. Key terms like contract and performance obligation anchor the standard, ensuring clarity and consistency. Understanding when a contract is valid and identifying the transaction price are critical. Revenue is recognized when control shifts, not just when cash is received, transforming financial reporting practices. Mastering the 5-step revenue model is crucial for ASC 606 compliance. Start by validating the contract, then break it into performance obligations. Accurately determine the transaction price, considering any variable elements. Allocation follows, distributing this price fairly across obligations. Finally, recognize revenue as you fulfill these obligations, reflecting true economic activities. Estimation accuracy is vital to capture the transaction's essence, driving precise financial insights. Grasping ASC 606's intricacies can set you apart in interviews. Recognize common pitfalls like misjudging variable consideration or misidentifying obligations. This standard unifies revenue recognition, moving away from the fragmented past. Expect to discuss disclosure demands, which now require detailed revenue insights. Expedients simplify life for similar contracts, but remember, estimation and judgment are central. Industry-specific challenges, especially with bundled deals, showcase ASC 606's profound impact. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.